So the conversation with Albert, he says, look, it's not really the days of yesteryear, maybe even the back half of 2016 where you just kind of buy stocks and they keep making new highs. When you talk with your clients who are more sort of that longer term picture, do you have the liberty of basically not having to worry about this stuff that's chopping around intraday, or is the long-term picture changing too?
Yeah, it's a great question. At the end of the day, what really matters is, okay, well, what happens next? That's what we're always trying to figure out.
Yeah.
You mentioned that a lot of our clients are actually retired, and for a lot of them, it's a question of how sustainable is the income or the cash flow that's coming off of the assets. And so you definitely need to be a little bit more long-term in focus, but the intraday makes a big difference. I think about people that are needing to take money out of accounts this year, and it's always a question of, well, how much and from which stocks and from when? Mm-hmm. You think about people that could have taken money out earlier in the year at a much larger profit than they did now, versus somebody who maybe delayed it towards later in the year. What happened with the volatility in October, and now they may be looking at a very different return or a net return than they could have otherwise.
It's interesting because part of this is basically, I guess, where you are sort of in that investment horizon, right? If you're retired and you say, I'm about preserving what I have, then does taking some out of the risk assets at a point make sense, as opposed to someone who might be saying, hey, even if stocks are going to be choppy, I got 30 years ahead and I know stocks generally go back up.
Yeah, in a sense, I think that's absolutely true. There's a lot of research around sequence of return risk and other things like that, and the ability to predict what any 1 year's return means in terms of the long term. And what most of it says is that, negative returns really early, or I should say right before you retire and right after you retire, really accounts for most of the predictability. So early in somebody's career where they have a long time horizon, not that big a deal. Nobody likes to ride the roller coaster,
right,
but they have time to make it back. And at the same time, somebody really well off in retirement towards the end of life maybe, also not going to be that negatively impacted by the volatility. But people that are right in that critical phase is going to make all the difference in the world for them.
When they have this discussion about, hey, let's say I've got 60% of my portfolio in stocks, I'm 75, I want to preserve that, I don't like the outlook for the next year, let me take some away. How do you figure out where to do it from? Is it just where they made the most money? Because we see things like the tech stuff drop, and there's also stocks that made a lot of money. They're still doing that, as we see even on a bad day for Boeing, it's still sitting at the high, and there's a lot of companies here that are still demonstrating that value, even as some of the big high flyers like the FANG stuff are just in pain.
I feel like it's got to be tailored to some degree to the individual.
Okay.
And it's really going to be a multifaceted approach as well, depending on where people shake out in terms of cash flow that they really need off of assets and the percentage of that cash flow to the overall household portfolio. Somebody who has a lot of income coming in, say from rental properties or pensions or Social Security, and only needs maybe a 1% cash flow off of assets is going to have a different risk profile than somebody who maybe needs a 4 or 5% cash flow off of assets. So it's always going to be about the convergence of data in terms of what's going to work for that unique situation, so to speak.
I'm curious about the pension part.
Yeah.
Given GE, right? Are not specifically about whether you have GE clients, but in general, are people looking at this company and starting to worry about their own? We know there's a lot of pension liability that exists in the U.S. equity market. Scott Minerd at Guggenheim said, hey, GE is basically, today in a tweet, he said, is basically the beginning of the investment grade kind of roll down of risk. How does that sort of factor into some of these decisions people have to make?
Yeah, that's a great question. I think, especially with GE, it tells a really clear story of just not having all your eggs in one basket. I think sometimes we hang our hats on the fact of what history has basically done, and the fact that good dividend payers have always been good dividend payers, since that means they will always be good dividend payers. But you can see some of the risk that corporations have in their fight to try to remain solvent. We were talking about how GE is now looking at a lot of different things, selling off pieces of the company, cutting dividends, trying to basically get back into financial health. But I think these pension liabilities are going to be one area that we're going to have to think critically about, just because it really does put pressure on corporations.
Yeah. When you talk about the cash flow need by any given client, it makes me think about bonds, and I'm curious to get from your perspective whether or not the offering and yield now that is climbing. It first happened on the short end with the Fed. We've got 2 years trading above 2%. Now the 10 years is closer to 3.25. Do you see more people understanding that they're getting more from it, saying, hey, all right, fine, get rid of some of my stocks. I don't need that utility or REIT anymore or whatever. Let me go pick up this 10 or 30-year bond. Is that happening?
To some degree. But unfortunately, I feel like fixed income just in and of itself is a world that a lot of the average investor just doesn't really understand. You know, they get it conceptually, and in their mind it's like, well, this is my safe money, it's a hedge against my more risky stuff. But I think there's a lot of opportunity really in the fixed income world. I think one of the catches though is that if you're trying to utilize fixed income from a cash flow standpoint, when you're in a rising interest rate environment like we're in right now, I think the opportunity is more so in individual instruments as opposed to necessarily in funds. I think there's a little bit more dynamic ability you can have in how you manage them, try to control duration risk without having to skew the risk profile
So
too
specific
far.
bonds.
Yeah. I think if you're looking at specific bonds, there's a lot of opportunity there that you can basically make, especially since, you know, think about the economic environment we're in right now, where the stock market is still floating relatively high. I know we've had some volatility and given back some of the earnings from this year, but if you look over the last few years, last 5 years, last 9 years, we're still at a relative high point. And I think that along with the fact that you're now having interest rates rising, putting some temporary downward pressure on the market value of fixed income, is actually creating some buying opportunities for people if they know where to source them.
It's a great point, because I think a lot of people forget, and we try to deliver this message as well. There's a price of the bond, right? It's going to go down if interest rates go up, but the yield that you're getting, the income, there's different reasons for owning bonds. You own a stock, you want it to go up, or you want to get a dividend. You might own a bond for one of a few different reasons. Is the income that compelling yet for the bond market, or do yields need to go higher before it becomes an easier decision for people?
I think it's in the realm where it really makes a whole lot of sense. You know, because of just the things that have been going on in terms of volatility, low interest rate, persistency, and things like that. You know, if you look at a lot of the safe withdrawal rate studies, especially in recent years, they've downgraded the whole 4% rule to now it's more like 3% or 2.8%, depending on how long you want the portfolio to last. So this is a fundamental difference between cash flow versus rate of return, because while a 4 or 5% rate of return may not sound that great in the long run, being able to get a 4 or 5% cash flow, even if it's off of dividends and interest, relative to the 3% you might have to take if you were liquidating shares, could be as much as a 25 or 30 or 60% increase in cash flow, even though the rate of return isn't quite as attractive. So being able to make that flip in your mindset from thinking about what are my income needs versus what are my growth opportunities can actually create other opportunities for people, because if I can get a higher cash flow off of this segment of my portfolio, then it actually allows me to do more of a traditional buy and hold strategy with other parts of my portfolio.
Sam, I think it's a great point. It's an important thing for us to keep in mind. We got to leave it there for now. Sam McElroy, great to have you.
Yeah, thank you.